There's this old joke in customer support circles where a customer calls in with a problem with a product that they're having, and the customer support agent says, yeah, there's this great novel about a Spanish guy named Manuel that we included with your product. Have you read it? And of course, they're talking about the person not having read the manual when they purchased the product. So I'm going to refrain from any sort of Jesus jokes today. We're going to say hello to hay-zeus. So he's a 30-year-old patriotic American, a self-described proud Latino. He's a corporate tax auditor for a state government. He's tired of content farmers discussing the same stocks over and over. He has an above-average tolerance for risk due to his age. It's good that he's identified that. And he's an enthusiastic member of our community here at Nanalyze. And because he's a Nanalyze Premium annual subscriber, that means he's eligible to have us conduct a comprehensive review of his portfolio, which is what we're going to do today. So let's start out with a little bit about his life. So he's recently married. Him and his wife have purchased a home at a 2% interest rate. That's phenomenal. We're going to look at just how good that is in a second. But he says we have almost 20% paid, and it's appreciated about 10% already. Well, we've had a discussion before about whether or not you would include home equity in your, let's say, your asset allocation exercise, where you look at how you've allocated your assets across different asset classes. And we typically would exclude that. He says he has a $1,200 I-Series bond. These are interesting fixed income instruments I wasn't aware of. As always, I learned something from these, and we're not going to talk much about fixed income. It's because hay-zeus isn't focused on that. So his cars are paid off, and he has no student loan debts. That's excellent work. Don't get tempted to upgrade your vehicle. He has about 20% of his salary in a retirement account with a 7% match. And he says he doesn't know how it's being invested. Well, first of all, you always max out on matching. That's free money. You don't leave it on the table. And go make Gwyneth and HR tell you how that money's being allocated. That's their job. So you'll want to, a lot of people won't pay much attention to these retirement accounts through their employers, and you'll want to pay closer attention to that. So when we look at the house that hay-zeus has purchased, so I've just used an arbitrary number here, $275,000, and we look at how that's impacted by an interest rate at 2%, which is what hay-zeus has, versus 7%, which is what you're likely to pay in today's market. And look at how much more money you're paying for a house. And of course, you need a place to live. So purchasing a house at a reasonable interest rate is certainly a good idea. Otherwise, you're paying somebody else's mortgage. So you can see here that for a $275,000 house, a 2% mortgage means you're paying principal a lot quicker. You see that blue line going up there quite quickly and in a fairly linear fashion on the left. That's a 2% loan. And then look to the right how slow that principal gets paid with all that interest. So it comes down to this. 2% interest, you pay around $350,000 for that house. 7% interest, around $580,000. So there's a big difference there. Now, hay-zeus has some thoughts on investing. First of all, this is his first year of investing, so he's a newbie. He doesn't quite believe in bonds and would rather invest in stocks and ETFs. So here at Nanalyze, we don't follow the old, 100 minus your age, and that's what you should have in fixed income rule, because of our dividend growth investing strategy, which provides us not with fixed income, but with growing income, which is what we prefer to offset the impacts of inflation. He says here bonds only pay about 5% annually. Takes about 14 years to double in value. Well, this is a more complicated topic, I think, for another day. We don't cover fixed income investing here at Nanalyze, and maybe we should a bit, but that's another conversation. He says, being a long-term investor, I figured my investments would double long before that. Well, because you're a buyer for 30 years, and we're going to talk about that, you want the markets to perform as horribly as possible when you're investing in them. So let's talk about time in the market. hay-zeus is 30. Collecting retirement from the government earliest at 62. You may choose to retire sooner than that, but when there's a difference there between deciding to stop working or maybe choosing to do something you love versus taking money from the government. Those are two different events. But let's say he's going to have 3 decades of investing. He's trying to achieve above average returns of 10% over the S&P 500. If so, he's going to be in the elite 5% of people who can actually do that over sustained periods of time. So we want to look at what he can realistically expect. So let's assume a couple things here. Let's assume the median U.S. household income of $74,000 in 2022. All right, let's assume that he makes that. Let's assume that raises going forward are simply going to offset inflation. When you work in a large multinational, as I did for a decade, that's typically how we would approach raises, and we would try to give our high performers more, but typically you would try to give them inflation, and that was calculated at a regional level or country level rather. So let's assume his income's going to stay fixed, meaning the raises he gets are simply going to offset inflation, all right? His employer is matching that 401k at 7%, so let's assume he contributes max. And then he's going to invest, he actually is investing, about 25% of his gross after that. So let's look at how, in this case, his savings would evolve over time. Now, in order to understand the growth he can expect, I pulled up this article from a website called Big Law Investor. It's actually quite good. And it looks at the compound annual growth rate of the stock market from 1871 to 2016. Then they also looked at the same growth from 1900 to 2016. And the data was provided by Nobel Prize economist Robert Shiller. And he used S&P data from 1926 to the present and Cowles and Associates data for the period prior to that. Now, these numbers include dividends as part of that return, which is very important. And they also provide inflation-adjusted numbers, and we're going to use those. Then the sums in the future should reflect today's dollars. In other words, $1 million in the future for hay-zeus is going to be $1 million today. So we're going to take that period from 1900 to 2016, inflation-adjusted 6.55%. We used that in this table. Here's what hay-zeus is doing, right? It's what he had in year one. Gains on what he had nothing, right? And then his savings, let's say I think it's $1,433 a month. And that's $17,205 every year that he's saving. So at the end of the year, you see, and the next year he has gains on that, right? And then he adds that same amount, and then you have the sum, and you go all the way down. And at the end there, at year 30, he's going to have $1.5 million. He's going to be a millionaire, right? With a healthy buffer. A couple things to note here. First of all, there's going to be a lot of volatility. He's dollar cost averaging. That's the magic here. In other words, if for the first 10 years the market absolutely tanks, that's what he wants. He should hope and pray that it tanks, because then all the money he's putting in, he's buying cheap quality assets. Then the market recovers and we see another bull market. Then he's happy too, right? Because he sees all his assets growing, but he's also paying a lot more for those assets as he continues to invest every month. That's the magic of dollar cost averaging. Now, this assumes no increase, as we said, in income beyond inflation. Now, Juan, he's relatively new to the workforce. He can likely switch jobs. He's a hustler, right? And he probably will, and escalate his responsibilities for wages that are higher than the increase of inflation over time. But one thing we didn't consider here is his 401k. So let's work that out. He's already been working for 3 years, okay? So we can put down what he has based on savings at 7%, okay? Socking away 7% of his gross with match. Gains here, we're going to put at 100 basis points less because 401k funds are expensive. So let's say 5.55%. That matching again at 7%. He's going to have an extra $750,000. We're now at $2.25 million. As they say in the UK, hay-zeus is cooking with gas. He's a millionaire. And he didn't have to do very much, right? He's an overnight millionaire after 30 years of work, right? He simply had to have the discipline to say, and he does have that discipline to save every month. Now, it's very important too where he decides to put his money, and he needs to be the one that decides where that goes, and he's done that. So I love his strategy. He says, maximize financial girth, invest heavily into growers, not showers. And I love that. He says, boring, unloved, less covered businesses. Industries have historically yielded above average returns with below average volatility. Okay, that's sometimes difficult. There's a lot of ways you can measure that. But what's most important about what he said here is that he has a strategy. So let's look at his portfolio. On a smaller side for market cap, so $21 billion average market cap, we see a lot of growth stocks here. Nicely diversified set of names. I love the information that he's provided here. So you're only seeing half of it. To the right of this on his spreadsheet is a whole bunch of financial information, but I wanted to touch on some things here. So I love how he's put a moat. He says, who are they? So he's thinking about that very concisely. And then the why, that's great. You should always have that. And I just wanted to pull out my red pen and make a couple comments here. Raymond James, good dividend growth. Okay, so they've grown dividends for 12 years. That track record is always important, okay, because a company can grow dividends for 3 years and suddenly stop paying dividends. The longer the track record, the more likely it is that they'll continue that growth. He says, a company is a master at what it does. He's referring to Kinsale Capital. These comments, master at what it does. He makes another comment here about a Mueller, extremely well managed, and then Copart, a remarkable founder and management. So, I'm sure has reasoning behind that. And I took a look at Mueller, and it seems like you could probably make that claim based on their deck. But when people talk, you see this on YouTube and social media all the time, say, the founder's remarkable, the management team's incredible. Did you work with them? And I'll tell you what, even if you work closely with a management team at a very large corporation, what you find is a lot of them are Muppets that just happen to navigate their way politically, and everyone below them is extremely competent. Very, very tough, even if you were at the C level. Okay, maybe if you're at the C level, you might be able to make some of those claims. But other bits here, he says, for Academy Sports, grew up with them. Be careful about the domestic bias there. So make sure that it says retailer for sports and outdoor equipment. We'll make sure that you're bullish on that, right? And then that they would be best in class. And then Peabody Energy, I thought this was interesting. He says coal is big in non-westernized countries still. Definitely, I'm in Central Asia now, and that's how I stay warm, is the bags of coal. It's really old school. And you look at places like Indonesia and the massive amounts of coal they're producing, or coal in China. Peabody's a pretty small player. I did look, they're exporting half their coal, so that's a fair statement he's made there. Coal is what powers EV charging stations. I don't know about that. Only 20% of electricity in the U.S. is generated by coal. So I used to be, back in the day, an energy investor in Peabody for whatever reasons. I can't recall. But anyways, those were some comments I wanted to make there. ETFs. So by the way, 50% of hay-zeus's investing dollars go into the portfolio that you're looking at here. Move on to ETFs. Here's the next 50%. We've covered SCHD extensively. We've got another piece coming out on that, I think, next week, probably the last in that series. Great dividend ETF as far as we can see. A low expense ratio. That's the most important thing that you need to pay attention to. Schwab growth. And I like how he's listed these out here, the number of companies, notable companies here. Took a quick look at Schwab growth. 4 basis points fee. Wow, that's so low. So great job there. Tracks a Dow Jones large cap index. I don't know much about that index. Have to dig into it, how it's constructed. But what we do note here is a heavy concentration, 50% in 8 tech names. So you want tech exposure. He did a great job of capturing it here at a very low fee. Now the other fund or ETF he's holding, this the Distillate U.S. Fundamental Stability and Value ETF, fairly low assets under management, $1.3 billion, high expense ratio, 39 basis points. And they have, it says here, they're selecting firms using the company's proprietary measures. So instead of following an index, they're doing some active management there. Very difficult for firms to beat their benchmark over time. You can see these guys have been around for 6 years. They've managed to do that, not by much. 2023 looks like they had a stutter step there. Be careful on how much you're paying an asset management firm for their performance, and pay attention to this over time. There's probably cheaper ways to get whatever sort of exposure you're getting here. Now, there were a couple slides that hay-zeus put together he wanted to include in this deck, and I was really stoked to include them. He says, as a brand new investor who is also planning his wedding in school and working full-time. Awesome, hay-zeus. I did the same thing, man. I worked full-time and studied for my undergrad. He says he watched hours. So he's not only working and studying and planning his wedding, but he's learning how to invest. He's looking about best stocks to buy now. Don't we all start there? And he had 3 questions. Is PE less than 20? So if you're looking to invest in growth, that's difficult because a lot of growth companies don't have earnings yet. Is dividend greater than 3%? We did a recent piece. The biggest mistake dividend investors make is looking for high yields. And did the stock stabilize after rising and crashing during COVID? Well, it's a temporary event, more or less. We seem to be back to the new normal. But he came up with this portfolio, 18 stocks and 8 ETFs. And then he says, while searching for videos on Cisco, our video on Cisco blew his mind. And I didn't think this video would have had such a big impact on somebody. I'm very happy to hear that it did. He said he learned that a company that's large and well established, maybe it can't reliably grow forever. We see this a lot with these old school brands that run into growing pains. He says, the fact that a well-known company like Cisco hasn't reliably grown revenues and made severe tactical errors was completely foreign to me. Then he points to a piece we did on 3M, and he says here, the videos marked the first time I saw reasons not to consider a stock. We say that all the time here. We say that everybody will tell you which stocks to buy. Nobody tells you which stocks not to buy, and that's why we take a critical approach to investing with an emphasis on risk management here at Nanalyze. So he says this laid the groundwork for him to revamp his strategy towards a growth-focused portfolio. He says, before I had no theme, thesis, or direction, and that's great. We helped him have a direction, create a strategy, and you notice his portfolio isn't mimicking. He's a paid subscriber. He knows what we invest in. It's hardly mimicking what we do at all. That's what I want to see, people coming up with their own strategies and saying, I'm investing this way because I have conviction, right? So his long-term goal, he has one that's great, is to invest growth and then move into living off dividend income. I think that's a great idea. So just some concluding thoughts. I love how you're thinking things through here, Jesus. This was a lot of fun to analyze and to work with you on putting together this deck, and it's just great to have you in our community and contributing to everybody else. So I'm going to put up another video here since Jesus is focused on finding the top growth stocks. We did this piece. The audio is a little bit off. I apologize for that, but it's a great presentation on how we identify top disruptive tech stocks. So thanks so much for taking the time to watch this today.